Good afternoon, good evening, and welcome to Technical Analysis Explained, our new show about technical analysis. I'm your host, Tom Schneider, CMT with NinjaTrader. Before we get into the good stuff, I want to remind everybody that futures and options trading contain substantial risk. And you know what? It's been so long since I've done this, Jason. I'm going to start over. We'll try to get this. I need to get that disclaimer up in front of me. Contains substantial risk. Substantial risk is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. Doesn't keep you up at night. Doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results. That's very key, especially when we're talking about these shows, technical analysis. Also, the information presented in this program contains neither trade recommendations nor financial advice, and therefore should not be interpreted as such. It is presented solely for educational purposes. And with that, let's get into this show's topic. So, apologize for that. It's been a while since I've read that disclaimer, and it kind of didn't have the disclaimer handy, so I was doing that on memory. But hopefully, we got through that so that we can proceed. Today's show, hope you got to see the inaugural edition. About a month ago, we had Ralph A. Campora on. He is the co-founder of the CMT. He kind of went through why we do technical analysis, but we're going to get into the nitty-gritty of some of these different indications in technical analysis. Technical analysis contains such a broad swath of different types of very particular analyses. So today we're going to start with what I think is the natural extension of price analysis that kind of blends into technical analysis, which is moving averages. So maybe, Jason, if we can just go right into the chart. And I'm going to try and keep this as simple as I can, because it is a fairly simple tenet with technical analysis. It's the moving average. And the moving average kind of comes out of this idea of what is trend. And what we're looking at here is a daily E-mini chart. And if we were to just boil this down, I'm going to take this down to more of the recent data. And I'm going to blow this chart up. It's going to look really big. But if we were to just focus on the current candle, and I asked you, the viewer, what the trend is, you would say it's up, right? It's very, very obvious that it's up. The green candle, the open at the low, the close above the open, very big. The trend is up. Okay, that's great. But this is just one candle in a sea of candles, in a progression of candles. So now if I wanted to see, well, what's the 2-day trend? I can pretty easily see that it's up as well. And the 3-day trend is up, 4-day trend. But wait a minute, we get to these red candles. And now we have to kind of rethink, what is the trend, right? Because this trend was down at some point before it became up. So what is the 10-day trend? I don't know if it's up. I don't know if it's down. It looks fairly the same. Now, recently, today, it's above the close of the bar 10 bars ago or 9 bars ago. So I can say from here to here, it looks up. But that isn't a direct path. So when we want to identify trend, when there's volatility, and we can go back and we can look and we can see that there are these candles that sometimes they go up, sometimes they go down. Sometimes they're bigger, sometimes they're smaller. How do we determine what the trend is? Well, moving averages can help us do that. So what is a moving average? Well, a moving average is defined by two things. It's defined by a length or number of data points, and it's also defined by what data point we're measuring. Generally, when we talk about the financial markets and we talk about a moving average, it's assumed that that is the price, the close price, I should say. So when we look at a candle, I know that on a candlestick, when we have a green candle, the close is at the top of the body, and the red candlestick, the close is the bottom. So when we talk about a moving average, we're talking about averaging a certain number of closes. So let's take a look. I'm going to switch over to a 50-day moving average. Now, why 50? Back in the day when moving averages were being explored as ways to identify trend, they didn't have what we have now. They didn't have a NinjaTrader 8 platform, right? They didn't have a calculator to calculate those averages. Well, a calculator that you and I might have used. They had these hand crank calculators sitting on their desks. They were big calculators, and it was easy to calculate the periods that ended in a zero. Let's say a 10-day, a 20-day, a 50-day, a 100-day, a 200-day moving average were those time periods. So I'm going to focus on easier or these, I won't say psychological numbers because it's a little different, but these numbers that end in zero, because that's what originally these moving averages, how they were calculated. So how do you calculate them? Well, it's very simple. This is a 50-day moving average. So if we were to look at this point right here, I'm going to get my ellipse and just kind of draw an ellipse around there, move it over. Let's see, here we go. And we're going to move this over right to the most current point. And I can see that current point is 42.79. Well, that represents, if we were to take, actually, that's not quite true. Let me do something real quick. I want to calculate on each tick. So I'm going to slowly move this over. And let's see if that applied. Nope, that did not apply. Let me try it one more time, because I have to be in the right study to do that. On each tick, here we go, 42.85. So that's the current 50-day moving average on the E-mini S&P 500 September contract. So what does that represent? Well, if we took the close of the last 50 bars, 1, 2, 3, 4, 5, 10, and we go out and somewhere out here is a 50, the 50th bar back. And we took the close from all of those candles and we added them up and divided by 50. That is the value we would get. And if you look at this bar, the previous value that we had identified, 42.79, that represents the 50 closes from that bar going back 50 bars, adding them up and dividing by 50. So you'll notice that at some points, price is above that moving average, and sometimes the price is below the moving average. So the average smooths out the data so we can look and say, this trend is up, sideways, or down. Right now, I would say, obviously, the trend is up. Why? Because that moving average is trending up. But if we look at March and April, we had some sideways action. We had some sideways trending. Yes, you've got a downtrend here and an uptrend here, and then some sideways action here and before the uptrend. But if we were to smooth out the data, I would say from March to about May, that is that future, that stock index future, E-mini S&P 500 was sideways. So it helps us identify trend. And we have to go back to last year and see where that moving average was trending downward. Now, this is a 50 period. If I were to change this to a different period, let's say a shorter period, let's go to 20. 20 data points represents 1 month's worth of moving average on a daily chart, 20 data points. Look at that. That moving average, the current moving average on a 20-day jumps up. Why? Because it's only calculating the close from the last 20 days. So the length of time will give us different values. And look at how the line is closer to the data prices, to the price action, right? This, when you use a smaller time frame, you're going to get a line that gives you a smaller trend. It's a shorter trend, and it's more reactive than a longer one. Let's take a comparison with the 200. We might hear about the 50 and the 200 as being kind of what they talk about on financial TV shows and in the news, radio. 50 and 200, again, going back decades when they were using hand crank calculators, those were the easiest to look at, to calculate. And that represents, about 2.5 months to 10 months. It's fine. Here's a 200. Look at that. 200 moving day, 200-day moving average is about 60 handles wide. If you look at this in the sideways, slightly uptrending, but it looks more sideways. If we go back to, let's say, November, the low was about 40.34, and now we're at 40.94. So not a big difference with that 200. But the 200 is using 200 points. It's not going to change that much. I have to pull in more data, in fact, to calculate that. If I go to my data series, I'm going to pull in, let's say, 1,000 points of data, 1,000 days of data, so I can see what that 200-day moving average looks like. So when we pull back and get more data on a longer term basis, we do see the trends. And we do see where the trends change. So that is one way that moving averages can help us, right? They help identify trends. They take the volatility, the day-to-day volatility, out of the market to help us see, okay, what is that overall trend? Now, one thing that you have with the moving average is because it's a set number of days, you could have a day where when we create a new print on that moving average, let's say, let me go back to the 50 because it might be easier to see. This is a 20. I'm going to double click and change it back to a 50 because I like the 50. I like to see what other people are looking at. Here's the 50. And this 50, it's hard to see in an uptrend and a downtrend like that. There's trending markets. But sometimes what you'll see is when we have a day where there isn't a lot of movement. Here's an interesting day right here. I'm gonna kind of focus in here a little bit. And it's kind of hard to see, but you see this big move here. Moving average barely moved at all, right? And in some cases, other times, it might have gone down, even on a big move up. Well, why is that? Well, to me, that means 50 days prior, there was a candle that was higher than this one, let's say. The close was greater than this one. And what happens is that data falls off because it's no longer used in the calculation. So when we go from one bar to the next, we're dropping off one value that could be bigger or could be smaller in a downtrend than the current data that's added as a part of that calculation. A new data bar, a new close we use, but we do drop one off at the end. It's called the drop-off effect. And sometimes you could see it where there's no motion at all, yet the moving average moves up. Here's an example, somewhat. Here's a candle that moved down and the moving average went up. Well, that's because of the difference in prices here. 50 bars ago, there was an even a lower price down here, and that caused the moving average to go up because we took it out of the calculation. So not a big deal when we're looking at trend, but there are some other uses for moving averages that might make that a big deal. So let's talk about uses of moving average. Why do we use them? Well, I did kind of go ahead of script and talk about trend, but the very first thing you might look at is, especially if you don't have a chart in front of you, I know that there are people who look at data as well. We look at data in our market analyzer. We look at price data, we look at change data, but we can also look at indicator data. And so you can actually pull in the moving average value using the indicator field in the market analyzer for your moving average. And we can do a comparison of where price is to where the moving average is. That's important for a couple reasons. One, it just gives me a sense of what the bias might be. If the close, like today, 44.79, the current price, is above the moving average, in one of the boxes I would check in the bullish side. Okay, let's take a look at a time where that wasn't the case. If we go back We go back to as soon, or, as recent as April or March, really. It did change in April, but in March, we were below the moving average. So anytime I look at the price here and I saw the price here was 39.98, we just crossed below 4,000. Where's the moving average? The moving average is about 95 handles higher, maybe 100 handles higher. Well, that informs me that maybe the market's bearish. And I can see that on the chart. Obviously, we see a downtrend here and we see an uptrend here. But if I just had those two pieces of data, where's the price, where's the moving average, it helps me form an opinion about the market. Now, again, this is very basic. This is the beginnings of an opinion. It's not the end of the opinion. I need a lot more information if I were to form a bias. But if I had to spot check what's happening for my different markets, I'm looking at my market analyzer and I've got all these markets. If I pulled in the moving average, I could actually color code those boxes and tell me red or green if price is above or below moving average. So just a quick comparison. What is a thumbnail sketch of the bias? Okay, that's the first thing. Second thing is trend. Are we trending up? Are we trending down? Not so important when we know that we can see the trend is above or the trend is below. And sometimes you'll see it like here. We've got this trend below. But important when we are trading around the moving average to know which direction the trend is. Is the moving average trending up or is it trending down? And it's hard to find. I've only got a little bit of data here, but a slight trend down. You'd call this sideways trending, finally trends down. But when we see this fluctuation above and below, I do want to know, okay, overall, the trend is up. The trend was down going into the end of the year. And then at some point in November, we saw this change in trend that it slowly drips up. And this is a 50-day, right? I can go to the 200-day and I can see what that trend is on a longer term basis. And we know that you can actually have different trends, identify different directional trends based on the different periods that we have. If I look at my E-mini S&P chart, now I've got a 50-day moving average here, and I've got a 200 in purple. So the 50 in blue, the 200 in purple, and you can see there are times, and again, I'll pull in more data just so we can see different times where the trends were identified as being opposite or different. Opposite might not be the word, but you can see here, 200-day moving average trending downward. Okay. And at some point, the 50 started trending upward. So that longer term trend was still down, and this shorter term trend was trending up. And let's see. And we can see the obverse here. The longer term trend here was trending up and really didn't peak until April of 2022. Here, the peak on the 50 was in January, full 3 months. But that makes sense because we have actually 4 times as much data coming in for the 200. It takes longer to turn that battleship than a little cruiser like the 50. So understanding that different periods can give us different directions, that'll become important before we talk about that trending idea, that trend change idea. I do want to talk about another way we can look at moving averages, and that is like what we might call a reversion to the mean. So a mean being an average. This market, because the average is calculated on the latest prices, because of that, the average usually follows the price. So if the price is trending up, and let's say this just kept going up, well, of course, the moving average would keep going up, because here, as we go along, these prices up here are the ones being calculated, not the ones down here. They fall off. But what that does is it keeps us honest, right? We can do a calculation. We can calculate the distance, let's say from the close. Sometimes you can do the high, but I think the close is a better representation in case this goes negative. The distance from the close to the moving average can be calculated. That's a spread. You can also use a ratio. So some people like spreads, some people like ratios. In the futures market, spreads are more common because generally futures traders focus on a less number of instruments or a less number of markets. Maybe you're a crude oil trader and a crude oil trader only. Spread's the way to go, I think, because then you get to know those numbers. But if you're a portfolio manager looking at one or two or three sectors of the stock market, probably want to do a ratio so you can do comparisons. But what that means is as the price gets away from the moving average, that ratio gets bigger or that spread gets bigger to the point where you could say, well, I think this might be an extended portion of that journey, and it's going to revert. Now, I don't know if this is the case historically, where this point right here was the most extended or very extended. I haven't done that calculation, but you can make that study just taking the close minus the moving average as a spread, or the ratio, the close divided by the moving average, to see, well, that could come down as a study down here underneath. And as it gets to extremes, we might use that as a mean reversion study. It's another way we can use moving averages as kind of an anchor point to price. So let's think. We've talked about comparison of price to the moving average just as an absolute. That can give us a little bit of a bias. We can look at trend. Okay, so we can look at the overall trend. And then we looked at the reversion to mean theory, where we can look at a spread or a ratio. But here's another thing that I think is very visual. And if it's visual, I like to think you can quantify it so that you can turn it into a calculation, but I don't think it's worth the effort. I think as day traders, we can simply look at the chart and we can see where a moving average might act as support. So looking here right away, you'll notice that once we cross above and we don't really come down to test this, we see a little bit of a trend, a little bit of a plateau, but I see these points right here. I'm going to bring up my arrow line. Right here, a test here, and I'm going to copy this a couple times. We have a test here, and we have a test here. So now you start getting a picture of, well, I've got this mean reversion theory that maybe if the market gets too far away from the moving average, there might be mean reversion. And then I've got this idea of support resistance. In this case, in an uptrend, it would be support. So we're far away from the moving average. Now we're getting close to the moving average right here. Is this a place where we're going to go through? If we do, it might be a change in trend. And we want to use that to our advantage. But it might not be. It might be support. So be prepared, right? A lot of times we've seen where the market comes down or from below, comes right up to and tests that as resistance. Sometimes it breaks through and comes right back down, tests it again, right? We've seen that a lot of times. But sometimes in an uptrend, we use that as support, and in a downtrend, it might act as resistance. So support, resistance, something we can see, harder to quantify. Probably can do it. I haven't tried. So the last item I hinted at just a minute ago, which is crossing. So I mentioned price crossing a moving average. And this is where the indicator becomes a signal. The technical indicator can become a call to action. Now, again, I do want to reiterate, Past performance is not indicative of future results. As we can see on this chart, there are times where the price crosses below the moving average and then comes right back up, or it crosses above the moving average and goes right back below. We call this getting whipsawed, where if I were to perform an action, I'm going to buy when it crosses above because I think that's bullish. We're going above, but then it comes right back down. I might get whipsawed. I might get out lower than the price where I got in. And then the same thing happens on the other side, right? We cross below and then the market says, nope, we're going right back up. And I might not be agile enough to get out with my, I might have a stop loss, but it just might not work the way I intended. And so when this happens, you can get a lot of what we call whipsaw. It's chewing up your potential profit. I'll show you where it looks on a 200 day can do that as well. We see that back here in the beginning of 2022. We just saw a lot of trading, a lot of what we call, again, whipsawing around the moving average. And then finally, we saw this downward trend, stayed down there. So some of the art in technical analysis is finding which moving average works for your trading, for your style of trade. Maybe a 200 isn't the way. Maybe it's a shorter time period. I know a lot of technical analysts use the longer term just to identify kind of a general trend change, a longer term trend change. And then as they go down into different periods, this could be a daily, it might be a weekly. I know one technical analyst, she uses a monthly chart, but her time period is still 10 months. She uses a 10-period moving average. So these are different styles and different periods that they have found work for them in what they're trying to identify. I'm going to go back to not this chart. We'll go back to the other chart with the 50 and the 200. Now, I don't recommend this. I'm not saying this is something that we should do, but for example purposes, crossing of moving averages could also indicate a trend change. And what do I mean by that? Well, we identified this period where the 200 moving average was still up, but the 50 was trending downward. That's a closer calculation to the price. So it's going to react to downward pricing faster than the 200 moving average. And what happens is you could do a couple things. One is you could use the price crossing the moving averages as a signal. Some people do that. You might wait till you get the moving averages crossing as a signal. And that usually indicates being further along in the trend. You're not going to identify peaks. You're not going to identify valleys, generally speaking. But if you want to be a little more conservative, it might be the way to go. Now, 50 and 200 is really a long term. As a day trader, as somebody who's trading shorter terms, you might try shorter period moving averages, a 10 and a 20, for example. And that's on a daily chart. You could certainly use these on intraday charts as well. I know we're running up against time. This is a lot to pack in a half hour, but I do want to mention one other type of moving average. And I think it's best to show it on the 50. Here's the 50-day simple. And the problem, or not a problem, but one of the things about a 50-day simple is each data point is given an equal weight value. So the data that happened 50 bars ago, which puts us right about here, is given the same weight as what's happening today. And as we know, a lot of information has come into the market. Things have changed. We've had probably one or two Fed meetings and some other economic data, and maybe some other programs kicked in, some other external forces. So there is another type of moving average that puts more emphasis on the most current value rather than 50 days ago. And that's the exponential. So I'm just going to go to my indicators and look for the shortened, the initials EMA right here. That stands for exponential. I'll do a couple things. One is I'll just take off the label. I'll update it on each tick, and we'll change it to a 50 so we can compare the time periods. And what I'll do also with the plot is I'll make it a little bigger and a little brighter so we can see this. So we'll take out this goldenrod. We'll make it we'll make it red, and we'll make it dashed. So real easily, you can see how it's a different value. Now it somewhat tracks the price, but it does have some variation. It does catch those uptrends and those downtrends before the simple. So for that reason, traders like that exponential, especially on shorter time periods. You notice this big move today. Look at where that moving average, the exponential. It's because if we look at it's a 50-day moving average. So I think the weight on a 50, so 4% or so, I'm doing the math in my head, 4% or so is of this calculation is just today's action, just today's price action. So a little bit more weight on today's data provides a closer moving average, or a more representative moving average, than the simple. Simple is traditional. It's what most people know, and it's good to follow. The exponential might be more helpful for your trading. So you might use that, especially on an intraday. I could change this to an intraday chart, and it would look just the same, except the bars would have different numbers down here. They wouldn't be months, they'd be minutes. That's the difference. So just to recap, I know we're running up against time again. Moving averages are great for identifying trend. Comparing price to the moving average helps us identify bias. If we're extended, we can use a ratio or spread to see if we're extended away from that moving average and should be mean reverting. We can use price crossing moving averages, or even moving averages crossing other moving averages, as a way to identify trend change, which might help us say, okay, we're no longer bearish, or we're no longer neutral. We're bullish, or we're bearish now. We're not bullish because our moving averages are changing. So much more to do with this. So much more to do with moving averages. And I hope you can join me for the next Technical Analysis Explained. This is a bi-weekly show, so we'll have another show, not next week, but in 2 weeks at noon. I'm hoping to have a guest for that one. I'm securing that guest as we speak, but it's a great guest, just like we had last time. And we'll go into a deep dive in another aspect of technical analysis. Later today, we'll have Mike Burke closing the week, closing the day, closing the quarter with bars closing. But in the meantime, I want to wish everybody a great trading day. Thank you.